Throughout 2024, many strategists have called for heightened volatility in the stock market due to the upcoming presidential election in November. Even though Carver's team here expected short-term bouts of volatility in early first quarter and then again mid-summer. The calls for market volatility and uncertainty around the November election kept many investors focused too much on political outcomes. Many investors kept themselves from pulling the trigger, from buying stocks on weakness, or worse yet, totally on the sidelines or going to cash throughout the year. Lately, there's been talk about hedging your portfolio for an adverse election outcome in a few weeks. I'm not exactly sure what that means, particularly when one looks at the cost of insurance versus actual market volatility. So what am I talking about? I'm talking about a bit of a technical data series I look at behind the scenes that's been quite good at defining the future moves, or at least which way many hedgers are leaning towards, and if it's a worthwhile exercise to spend the money to hedge. We've discussed these three data series many times over the last few years. In order of relevance to an investor, in my opinion, they are the following. First, number one, volatility is measured by the CBOE VIX index, which most in the media refer to when discussing market volatility. As a reminder, the CBOE Volatility Index, the VIX, is a calculation and it's untradeable. It's meant to represent the market's expectations of near-term price changes in the S&P 500 cash index within a 30-day forward projection of volatility. The second measure of volatility is realized volatility, or RVOL. This is the measurement of the actual volatility in the S&P 500 index over the last 30 days. This is also called historical volatility. This is the volatility you see on your screen when you watch stocks on CNBC or Bloomberg, or when you sit in front of your screen and watch your stocks all day. Finally, my favorite measure of volatility is vol index futures. This is the markets for traders to trade their beliefs about what volatility will be in future months. To me, this is a particularly good measure of the true cost of insurance in future months. It isn't some math equation based on a basket of index puts and calls. It's traders' forward expectations of the future, and you are charged accordingly to wager or hedge or protect your portfolio against volatile market moves. Many market strategists have thrown up an alarm warning most of the year, warning of stock market risk around the election. The work our team has done throughout the year has said much of the risk in the markets that others have been warning of that have kept many investors from investing and enjoying some, if not all, of 2024's 20% plus year-to-date index gains had mostly been priced in already. And in 2024 would likely turn out to be a very normal year and a good year for the markets. I've noted the same thing since the year started. What's that? It's that almost everyone is already nervous and hedged with the same time frame in sight. They've been that way all year. The insurers and the market makers in the volatility markets have been charging investors near the exact same premium all year for the same time period most are worried about. Investors, we've shared this chart and table before, but here it is again. Take a look at the chart of the relative moves in realized volatility, that's RVOL, which is actually happening in the markets, a spot VIX index, or what the math majors who don't trade say volatility might be over the next 30 days, and the forward volatility future continuous contract for the week right in front of the presidential election. The October vol expiration, which was the 16th, that was 2 days ago. I've also added the vol futures for November expiration, which is after the election. The first chart here plots the absolute level of each. RVOL, that's actual volatility, is in white. Spot VIX index calculation is in yellow, plot like a warning flag, but remember, it's not predictive. The October vol futures contract for pre-election is in red, as if it's been warning most strategists all year. And post-election volatility contract for November in green, kind of representing the supposed exhaling of concerns post-election in the all clear. Now, investors, take a look at the exact same data plotted as a percentage change from January 1st throughout the year. As one can see, the actual volatility in stock prices as of this filming on Monday was down by minus 14.5% year to date. Yes, investors, your emotions and eyes deceive you. Stock price movements are now lower than at the beginning of the year when the election was less of a worry for most of us. This spot vol index is up 32.7% since then, and the volatility for pre-election ending this week is essentially flat at up about 1.2%. In other words, the cost to insure your portfolio for the election period at the beginning of the year and now is nearly identical, while the cost of hedging for post-election turmoil that most people talk of, the economic, political, and market forecasting doomers, those waiting on the event to get invested, That's down over -6% since early January. And the S&P 500 has gained how much year to date? Well, as of filming, over 22% in price and 23% in total return, including reinvested dividends. Take a look at the year-to-date plot. As you can see, realized volatility at the beginning of this week was under 10. Yes, folks, with the stock markets at all-time highs, up over 20%, and the election approaching in 2 weeks, actual market volatility is nearing its low for the year at under 10. Wars in the Middle East, presidential candidates dropping out and being replaced, the other candidate being shot at, the Japanese yen carry trade implosion, an AI investment cycle hype or not, and new all-time highs in stocks and virtually new lows in realized that's actual volatility. On the other hand, the continuous contract for October expiration, UXV4, has been nearly the identical price throughout the year. As of this writing, it's priced around 20, and throughout the year, anytime it's risen to between 20 and 22, sellers of volatility have come in and buyers of the S&P 500 have shown up. It happened in early first quarter 2024 during the pullback, again during the April decline, and in a big way during the yen carry trade panic in August. Will it happen again and buyers buy the dip on any political panic or third quarter earnings weakness in the overall market? Our indicators continue to say yes. It shouldn't be different this time, and regardless of what you've heard on TV since late 2022, and again in late 2023, it's still a bull market until it proves it isn't. And investors, in my opinion, 2024 has been one of the most hated bull market year runs I've seen in 35 years in business. Why do I say that? Because it's been costing you 2 times actual market volatility to insure your portfolio. It has cost you between 20 and 22 vol all year to insure yourself for the election. The market makers have known all year that investors would be fearful and made you pay up for insurance. Even back when spot VIX was near 20 in April, it cost you around 21 volatility to insure for the election. I've found over the last 20 years of investing that while never perfect, nothing in investing is, it's very, very, very rare for the market makers who traffic in forward volatility markets, the volatility insurance salesmen, I call them, to misprice future market risks outside of black swan events like the COVID pandemic or other unpredictable events. In fact, if anything, my work says most of these hedges will expire worthless and cause markets participants to cover higher or at least pressure stock prices higher for longer in the fourth quarter of 2024 throughout early 2025. This is actually the reason I've mentioned that the math behind the market says that not only was 5,800 year-end S&P 500 likely to be too low, but the 6,000 end of January 2025, which we first discussed in October of 2023, was also likely to be too low by upwards of 200 plus S&P 500 points. Investors, it's a bull market until it proves itself it isn't. If you're uncomfortable with a wider range of possible equity outcomes, the Oak Harvest team has launched a new strategy that retains the ability to go long stocks, short stocks, as well as buy partial hedges and shock absorbers for a stock portfolio. You can go to our website, oakharvestfunds.com, to find information on this new strategy. From the whole team here, from Eric behind the camera, myself, from Chad and Stu over here on the right that you might hear in the background, have a great weekend.